Hello, 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 hello. Greetings, Juneteenth family. Here we are again on another Thursday at 12 p.m. meeting for our weekly learning labs. Used to be our monthly, now our weekly learning labs. This week we have Juan Pedroso. Pedroso, am I pronouncing that right? Come on up with me, Juan. Hi, Juan. How are you
Hello.
today?
Good. How are you?
I'm well. Thank you for asking. How are you today?
Good.
All right. Well, community, Juan Pedroso is here to talk to us today about taxes. He has been working in taxes and accounting for 13 years. He's a graduate of Baruch College. He is an IRS enrolled agent. He is also a member of the National Association of Certified Public Bookkeepers, otherwise known as the NACPB, and a National Association of Enrolled Agents. What are you here to talk to us about today, Juan? Please tell me more. I don't want to presume or assume. Tell us what you are here to teach us about taxes.
Today we're going to talk about 10 tax write-off every business owner must know. Some more obvious than others, but today we're going to focus on tax write-offs for businesses.
Super. Well, I'm super excited about that, being a small business owner myself and starting a new LLC here in Atlanta. So I definitely look forward to hearing what you are going to teach us today. I will step away from the table and let you get going. And welcome,
Thank you.
community. Please feel free to drop any questions in the chat box, and I will make sure that Juan gets them so that way all of your questions are answered if there are any. All right.
Yes, great. Thank you. Good afternoon, everyone. Um, just a couple of side notes. Any questions that are not addressed today, obviously due to time, I will gladly reach out to you and then answer them on an individual basis. Also, as well, the write-offs that I'm talking about are not the only write-offs. I just, picked 10, um, and I will summarize on each one. Okay, because obviously there's a lot more into it that we wouldn't finish today if I got into all of it, right? So, um, any questions on anything that even is not mentioned here, that you maybe expected you were going to hear and you didn't? Again, we can speak about it on a individual basis at a later time. Um, if you can pull up the slide, yes, thank you. All right, so today we're going to talk about 10 deductions every business owner must know. Obviously, we all go into business. Pretty fortunate to be in a country where it's pretty easy to get into business. It takes maybe what, half hour, 45 minutes, fill out some papers, get a tax ID, and get the ball rolling. So, and obviously, we're all trying to make money, and also we also want to maximize our tax savings without breaking the law. Obviously, we don't want to pay too much of what we have to pay. We know we have to pay, but obviously, we want to pay what's fair and not break any rules. So today we're going to talk about 10 deductions, and we could go to the next slide. Okay. So the first one we're going to talk about is business startup costs. Okay. We all have to spend money to start a business. There's no surprise there. Now, startup costs are amounts business pay or incur to creating an active trade or business. Okay. Also include amounts paid in connection with existing activity engaged in for profit. I want to briefly emphasize the engage for profit part because actually every year I get a couple business owners that tell me, okay, well, I put in the time, put in the money, made nothing. And although there are circumstances, yes, that is correct. Every time we're starting, most of us start from zero. I started from zero as well, so I totally understand that. But in that situation, sometimes you have to get a little bit more in depth. Are you really trying to make money? It was just a matter of COVID hit, or I just didn't make any money, but I really, really tried. Or, there's always that fine line. Where is it that, or is it the other side? that unfortunately some people try. You're just putting in expenses to, try to lower your income and get away with paying less taxes. So there is that fine line between those two. So it's always making the attempt to try to make money. Yes, there are times that you try, takes a couple months without making a dime before you make your first dime. That happens. But the intent of trying to make money while you're investing your time, while you're investing money to start up the company. That's a big deal here. And for the first year, you're going to deduct up to $5,000. Okay. If it's more than $5,000, the rest can be spread out over a 180-month period going forward. Okay. Now, startup costs. What is included in startup costs? There's many factors of it. Obviously, you start an LLC. First thing you got to do is you got to pay the state, right? A fee to get the LLC going. If you don't do it yourself, you have to pay the person who's getting these paperwork done to get these things started up. So I just put a couple of examples there. Advertising is one of them because you got to now you have the business, now you have to start trying to bring in people, right? If you want to hire a team to help you, depending on what level you want to grow right away. Some people want to, get investors. They want to go for the gold right away, so they bring in a big team. And salaries and wages paid to those employees involved in that startup phase is also included. Any travel? Some people, this used to be very common when you wanted to sell, when you wanted to retail products. Some people literally went to China to meet people, literally went to Japan, literally went to these countries to try to meet with manufacturers, meet with suppliers to come back to the U.S. and sell the products. So travel related to that is also there as well. And obviously the legal and professional fees, as I mentioned before, if you're not starting the company paperwork yourself, whoever you hire, you got to pay them as well. So these are some of the startup costs that you're allowed to deduct in general. Next slide, please. Okay, so the next one is the business vehicle deduction. Okay, this is a popular one. I'm pretty sure many of you have heard of this one, where you can deduct. There's two types of deductions. There's the standard deduction given by the IRS with the mileage, okay? And then there's the actual expenses. Now, when we're talking about mileage, one of the key questions that you have to ask yourself to determine what's deductible and what is not is, where am I going? Okay. I leave home. Where am I going? Am I going to work? That's deductible. Am I going to meet a client? That's deductible. So that's one of the big questions you need to ask yourself to determine what's deductible or not is, where am I going? Am I going home from work? Yes, I understand. I was at work. So, technically I was working, but now I'm going home. That part is not allowable because that trip home involves no activity related to making a profit or trying to make money. So that part is not allowable. I'm at work. It's 12 o'clock. If I'm smart, I'm not missing this webinar. Just kidding. But I missed the webinar. I couldn't do it. I had to go out to lunch while at work. That trip to go to lunch, not allowable because you're not working at that time. Not the trip you're doing, even though it's in business hours, not involve actual working, so therefore not deductible. Okay, so those are just a couple of examples. There are great apps that you can use to keep track of your miles because obviously the IRS requires that you substantiate your expenses, that you have adequate records showing whatever miles you're going to deduct on your taxes. Okay, if for those of you who have QuickBooks, you can download it to your phone, set up the location spot on your phone, and QuickBooks will track your trips. And then when you finish the trip, you can go into QuickBooks, and it's a pretty easy swipe, either personal or business, depending on what you did. So you have to keep actual track of what you're doing. So like I said, apps like QuickBooks. I know Uber and Lyft. Anybody that does Uber and Lyft, they do a very good job of keeping track of your miles for work. Even on their like tax summary at the end of the year, they give you how much miles you did with them. It's very helpful. Very helpful for us preparers to get that kind of information. What happens if it is a working lunch session? If you're like you mean lunch with a client, if that's what you mean, if it's lunch with a client, that expense would go on to it would you would the meals of that meeting would be deducted, that part. But going to the part of going to lunch, that mileage part, no. And the IRS for 2021, it's 50 cents per mile, per business mile, allowing you to deduct. Okay. Now the second type, if you can go to the next slide, please, is the actual expenses. Okay, so there's two. There's mileage, if you want to choose that, and then there's actual expenses. Right, cars are very expensive these days to keep up. You got the gas, which is very expensive these days. Oil changes. You got tolls. Many of us, toll bridges looks like it's everywhere these days. You got tolls, insurance, repairs, etc., etc. Again, these are all the business portion of these expenses, right? Whatever is gas you spend to go to work, whatever toll you spend to go to work, not the toll on the way home. Sorry, not the toll on the way home. No, etc. Now, when it comes to payments, I put the payment section there. There's obviously two types of car payments, right? There's finance payments, and then there's lease payments, right? If it's a finance payment, you can deduct only the interest portion of that car payment related to business. Again, related to the business portion. Everything I'm talking about, and I will be talking about, we're talking about business. You have a job, you have a W-2 job income. Unfortunately, all this goes out the window. None of this applies. This is all related to your business. Okay. So, and then you have the lease payment for those of you who lease cars. You can deduct the lease payment of the car. Now, another side note, if you're leasing a vehicle and you're going to use the standard mileage rate, let's say that's more beneficial, because obviously we're going to go with the beneficial. The law allows you to go with whatever benefits you the most. As long as you have your data to back everything up in case you ever get audited, it's fine. You can pick whatever benefits you. So if you're going to use a standard mileage rate and you're leasing a car, you have to use that same rate. You have to use that same method, through the time of the lease of that vehicle. So if you're leasing a car, you can't go back and forth. And if that first year, you're going to use that. That's what you got to stick with through the time of the lease of that vehicle. Just a side note. Okay. Next slide, please. All right, then you got depreciation. Okay, what is depreciation? Depreciation is obviously loss of value when we buy, merchandise that we buy, assets that we buy. We buy cars that depreciate, computers that depreciate, etc. So cell phones depreciate. Many of the things we buy do depreciate, right? And then we are allowed to recover that cost on the taxes, right? Obviously, what are the requirements? Property must be owned by you, and the IRS does consider you owning the property even if you have debt on it. So if you're financing a car and it's still considered yours. If, let's say, a home, if you're in real estate or doing rentals, even if you have a mortgage on the home, it's still considered as an owned property. So that's still allows you to depreciate that. It must be a business or income producing property. Again, what we talked about earlier. You have to be trying, this is something that you're using to try to make money, to actually have a conscious effort of trying to bring in income. And you're using this tool to bring the income. So it has to be that as well. It must have a determined useful life. What is considered a useful life? Something that will run out, that will wear down with time, with use. As you use it, it will start wearing down, it will start deteriorating, it will start being worth less. That is what is considered a useful life. Anybody that's interested to know what years for per asset, we can get into that on a separate conversation because if not, we won't finish today. Okay, it must be expected to be more than a year. So I bought a cell phone, iPhone 12. Now we have iPhone 13 or whatever it is coming out. Oh, 3 months later, oh, let me get the new one. Now you can't. You can't do the iPhone 12. It has to be at least more than a year. And it cannot be property that would help you, and this is just layman's term, it says capital property there, but its layman's term is increase the value of your asset. For example, if you have a home, if you put an elevator in the home, the elevator will increase the value of your property because it's got more stuff. But you cannot depreciate the elevator. That portion you cannot depreciate in that example. So you can still continue to depreciate your home, and the cost of that would go into the home, added to what you can depreciate. But the actual elevator, just because I bought an elevator, you cannot depreciate the elevator in that example. Okay? And a rule of thumb to know what is a depreciable asset, what is not, you can use around the $2,500 as a rule of thumb. I'm not saying that it has to be more or less. I'm just saying the rule of thumb to kind of determine what is an asset and what is just a simple expense is around the $2,500 range. Because not everything can be depreciated. Not everything can be expensed. Not everything can be depreciated. So that's where the $2,500 rule of thumb comes in to kind of determine what goes where. Okay, and for beginning in 2020, the maximum depreciation is $1,040,000. And again, there are more figures that go into it, but again, it's something for an individual conversation if you'd like to know more, because there are other types of assets that can go up to the 2 million range. But the average is the 1,040,000. Most of the items we end up depreciating fall under that category. Next slide, please. All right, home office deduction. Big deal, especially during COVID. We were all home working, or most of us were all home working if we had the option, right? Small clarification. If you had to work from home for a job as an employee for a company, unfortunately, this does not apply to you. Yes, I know you worked from home. I know. Unfortunately, the job part, not allowed. This is simply for small office that you use for business purposes. Again, going back, and I reiterate, because this is a big deal, because there is a fine line between allowable and unallowable. You have to be trying to make money. You have to make the conscious effort to be in business, to try to grow your business, to try to bring money in using these tools. Okay? So there's two methods of the home office deduction. You got the regular method and the simplified method. All right? Under the regular method, okay, it is a percentage depending on the square footage of the office compared to your house. So for example, if you have a 1,200 square foot house, 300 square feet is 25%. Just throwing out there, right? So whatever expenses you're allowed to take, like rent, like utilities, it would be 25% of that. Internet, right? It's a popular one as well. 25%, and I'm just saying the example. So it starts off calculating the percentage, which is the square footage of your office, your little corner that you use, divided by your square footage of the place you live. That percentage you multiply by all the expenses that I'm talking about. And like I said before, there are more. We can definitely go into detail over a call or Zoom on what they all are. And then that is the amount that you're allowed to deduct for your home office expense. Then you have the simplified method, which is exactly what it says. It's simple. It's $5 per square foot of your office, maximum of $1,500. Pretty much it. That's simple. So you multiply $5 times on a square foot of your office, and that's your simplified method. Maximum of $1,500. As I said before, you are allowed to use what benefits you, as long as you have documentation to back it up. That's a big thing. That's a big deal. Like I said, all these deductions have fine lines between, are you really doing this? Are you really not doing this? That's why the IRS is always emphasizing documentation, and are you really trying to be in business while you're doing all these things? Okay. Next slide. All right, insurance. There's many types of insurances out there, and all these are insurances that you're allowed to deduct. If you have health insurance, dental insurance, and these are business policies, by the way. Just individual is a different type of deduction. I'm talking about business here. Okay, overhead. Now, overhead normally gets characterized under disability. And the reason I didn't put disability is because there's a fine line here with the disability insurance, because overhead pays for overhead expenses during long periods of disability caused by injury. So it may bring up the question, oh, okay, so that means I can deduct disability insurance, right? Not quite. Because the part of the policy that covers for lost earnings due to sickness or injury is not deductible. Only the overhead part, which covers business expenses while you're sick, is the part that you're allowed to deduct. So that's why I didn't put the word disability in there, because a lot of times disability and overhead, it kind of gets mixed up. It's put together. Like, oh, it covers you, gives you income, covers your business expense. They try to put it all bundled up together. But for tax purposes, you can't bundle it up. Only the overhead portion of that premium is what is deductible. Then you have your business liability insurance, your errors and omissions insurance for all you professionals out there. Very common, must have. So these are all deductible. Now the HSA, HSA is a pre-tax contribution you can make for a health and savings account. Now, you can actually end up getting a triple tax benefit off of this one. How? You deduct on the employee side as a worker. Company can turn around and match up to the limitation, which the limitation for a single this upcoming year will be $3,650. If you're doing a family policy, which you can, is $7,300. So the company, so you as the worker can contribute, the company can match deduction there, and then it's tax-free if you use it for health expenses. So with that one, you can end up, doing a triple whammy, like they call, and not get in trouble for it. What do you know? And then you have long-term care insurance as well. Again, these are all business policies, not personal. Yes, you can deduct some of these on your personal side, but again, that's another story for another day. These are all related to business. Next slide, please. Qualified business income deduction. Okay. Now, qualified business income deduction, in layman's terms, is 20% of your qualified business income can be deducted from your taxes. Now, as you can see there, I just specified because not every business qualifies. The only businesses that qualify are related to your personal taxes. Let me explain. Sole proprietorships, it's a Schedule C on your personal taxes. Single member LLCs, Schedule C's on your personal. S corporations, you get a K1 where you put that on your personal taxes. Partnerships, same thing. Trusts, estates. These are all entities where your income gets put together with you as an individual. C corporations, which are just separate entities from the individual, are not in this category because whatever income or loss the corporation, C corporations make, do not affect you as an individual. So these are only entities that affect you individually. That's pretty much how you can determine if you qualify or not. Does it affect your individual taxes? If it's yes, qualifies for business income. If no, does not. Straightforward. And it's 20% of income. Again, we're emphasizing that one more time. See, you get the rhythm here. You see the trend here. Income, trying to make money, trying to bring something in. These are all related to that attempt. So you're allowed to deduct 20% of qualified business income. Now it's also net income. So it's after you got your gross, then you have all your expenses. That amount at the end is where you get the 20% off as well. Okay. Next slide. All right, self-employment tax deductions. So August 14, 1935, President Roosevelt created the Social Security Act, right? And what basically the concept is, employees pay a portion of Social Security and Medicare, and the company that you work for, which was very popular at that time, and it was for decades after that, would contribute the other part. Okay, so you had your chunk taken out, which is still the case today, and then you had the part that you didn't see, which is the company paid out that part. That part you don't see on your pay stub, so you never really know, but it's there. They have to pay it on your behalf. Okay, now again, in the 30s, the 40s, the 50s, the 60s, the 70s, it was very common for an employee to work at a corporation. So this plan you would think was genius, right? It worked. It's a perfect proof plan. Can't go wrong. As time goes on, and especially today in the gig era and all that, now people are starting to shift away to work for themselves. So then what happens? Because now there's no corporation in the middle. Now it's just you. So what happens then? So with that being said, the IRS allows you to deduct that other half of self-employment, the one that you don't pay as an employee because the company pays for it. Now you are the company, you're the employee, and you are the company. So they'll still allow you to deduct the company part of that in your taxes. Okay, and I just put the half of what it is, 6.2. So it's 12.4 for Social Security is the whole amount that gets taken, and 2.9 for Medicare. So half of that, each one, gets deducted as you consider the employer portion on your taxes. And you individually are responsible for the other half, the self-employment tax. Okay, so that's where that concept came from. And it's still going on today. It's just that many of us are now, not holding as much jobs or not spending 30 years in a corporation. So now these are things that we now have to face. These are things that we are now more involved in than prior generations or maybe, prior decades as well. Okay, next slide, please. Okay, interest deductions. Okay, now again, this is business portion. There are other types of interest you can deduct on your personal side. Another story for another day. These are just business interest deductions. Okay, one of the common ones are credit card interest. If you have a company card, okay, I have to emphasize that because many of us, we start off, we don't have business credit. Okay, we don't have business credit, so what do? We just get a personal credit card. Very common. But then the interest portion of these credit cards in that situation is not deductible because you're just paying a personal credit card. Don't get me wrong. Don't misunderstand me. You're using credit cards for expense your business. That's fine. That's fine. There's, as long as you keep your books in order, keeping everything tracked, you're fine with that, even though you're using your personal credit card. Not recommendable, by the way, not recommended. I'm not recommending a personal business credit card to use for business expenses. I'm just clarifying that if you're using a personal credit card, the interest on that personal credit card, you cannot deduct if it's under your name personally. If it's under the company card, yes, the interest on those credit cards, go ahead. Business loan interest. For those of you who do retail, I've noticed that Shopify, PayPal, Square have started, well, not started, they've been doing this for a while, where they take off a percentage of your sales to pay back whatever loan you give them. It's become a common one, and it's not a bad strategy, don't get me wrong, but just it's very important that we find out what interests are involved in that, if any, right? Sometimes there's just not. Sometimes they just do it for the convenience because they know that it'll be easier to get your money, get paid if they take it off of the sales. But if there are any, it's very important to find out because the interest involved in those payments are deductible. And sometimes they're not as obvious for the same reason. Because they're taking it off of your sales, you may not be as focused on it. You only receive the net amount. So sometimes it can fall off, and sometimes you can ignore those things because, okay, it's being taken out of sales or whatever. But those things are important to look into because, whatever interest is involved in those little payments can add up. You can deduct that. Vehicle interest, as I mentioned earlier, with the whole vehicle deduction, the deduction on the vehicle expense, the car payments, only the interest portion related to the business use of that vehicle. That is the only part you are allowed to deduct when you are financing a vehicle. And it must be for an accredited institution. Okay, so if you borrow from your brother and he charged you interest, shame on him. He shouldn't have charged you interest for family. But if you paid him interest, that is not deductible. So it has to be from an accredited institution. And what is the most popular accredited institution we know? A bank. Okay. Next slide, please. Retirement deduction. So we're business owners. Many of us are individual business owners. We focus so much on just trying to go, make money, grow the business. I mean, if you hang around Athenia long enough, trust me, you will grow your business. But sometimes we get so focused on the growing aspect that we kind of forget some details like retirement, like our future. I mean, we love what we do. That's why we get into it. And sometimes at fault, because we love what we do, we may not be thinking about that there will be a day that we're not doing it because we enjoy it so much. I mean, I've been at fault for that. So sometimes, you enjoy what you do so much that you don't stop to think about that, hey, there may be a day that's it, I'm done. And that's where the retirement deduction comes in. Okay. I just put a couple. For solo 401k and set plans are just two of them. There's more. But individuals can open company retirement accounts just like any big corporation. Okay. 401ks are very popular amongst corporations. We're pretty sure everybody's bumped into one at some point if you work for a corporation. But there's also solo 401ks that you can do as an individual. You can elect to do referrals up to 100% of your compensation. Okay. Again, as I put on parentheses, I emphasize on your earned income. Got to make money. Now, for a self-employed individual, earned income would be calculated as your income minus your self-employment tax. So it would be after that. That amount is that you can do up to 100%. Now, again, as I mentioned earlier with the Social Security situation, if you're a business owner, you're the employee, you're the employer. There's no buffer in the middle. Okay? So as the employee, you can contribute. As the employer, which it's also you can match. You can match yourself. Totally fine. No problem. Up to 25% of the compensation of what the employee, which is the other side of you, is putting in. Okay. And then you have SEP, stands for Simple Employee Pension Plan, which is again, it's another pension plan that you can create as an individual business owner. Okay. Pros of these plans, they are easy to set up, low administrative costs, so they don't cost too much. Flexibility on the annual contributions. Okay, so if you want to put 3% now and then change it and not put anything, that's fine. If you want to go up, times are good, you want to go up to 10, go right ahead. And again, there's an employee and an employer portion of it. You can always match yourself up to whatever yourself puts in, right? Now, there is one con to retirement in general. And again, we go back to growth. Most of you I know are going to grow to a point where you're going to have people come on to your team. And any employee you bring on, this has to be available to them as well. And if they want to take advantage of it, you gotta adhere to the same rules to yourself, to them as well. So, I mean, it's obviously not bad that you're helping out your employees, but like I said, if you get a team of 5, 10 people that, say, wow, this plan is awesome. Now, you got to come out, it increases your expenses as an employer, which is what you would be at that point. So I guess that's considered the one con to this plan. It has to be readily available to any other employee that you bring on. Now, the total contribution for this plan, both employee and employer side, for 2021 is $58,000. And this is an individual contribution. So for any of you that have your business and also have a job on the side, a W-2 job, whatever it is, it's your total contribution. So if you got your solo 401k here and then you have a company 401k over here, it's the whole thing. Applies to you as an individual. So it's $58,000 for you total. And that includes your contribution plus company matches. The only part that is not included, for those of you who are over 50, the catch-up contribution, which is going to be $6,500 coming up, that part is not included in the $58,000 calculation. But everything else from your business, from any other job that you have, will get calculated into $58,000. Okay. Next slide. All right, and okay, we're doing good with time. Last but not least, bad debt deduction. This is one that's not very common. I put this in here because of that, because it's not very common. I know not everybody talks about this every day. There is obviously a fine line with this as well, and it is the bad debt deduction, especially with COVID, right? Unfortunately, that became a thing. Sometimes you just didn't get paid. Now, but what is considered bad debt, though? Loans to clients, suppliers, and distributors and employees, right? That's one example. So if you loan money, I don't think there's anybody here. I don't know how many people here in the banking business, but anyway, any type of loan that you did related to these business categories and they don't pay you back, it's considered a bad debt deduction. Okay, and again, you have to substantiate that you made an attempt to collect the debt. This person had a debt with you, or this company, had a debt with you, paperwork, either an agreement or whatever the case is, right? Also, credit sales to customers. Some of our clients, are we would love to just, here's your item, here's your service, here's my money, let's go home, have a nice day. But it's not always like that, right? And then this is for both new and old customers, right? Some of the old customers, they just get into the habit of, okay, you did the job, I'll pay you on Friday. Okay, great. They've been with you long enough, so you're like, all right, fine. no big deal. But turns out things happen like COVID, and then turns out they can't pay you. That's also considered a bad debt. Again, you have to have shown effort to charge to try to collect this money, documentation that they owed you this money in the first place, example, like an invoice or any type of agreement like that. Okay. And you also have to determine that this is really lost. Like this person is just not going to pay me. That's another factor that gets looked into the bad debt. This is something that, you know what, I give up. This person is just not picking up the phone anymore. It's been a year and a half, 2 years. They're not going to, chances are they're not going to pay. So then that's another requirement for it to be considered bad debt. And also any business loan guarantees. If a company, this happens a lot with net 30 invoices, where like, okay, I'll ship you the product. You have 30 days to pay me. It's so similar to the credit, obviously, but yeah, that's a popular one that I've seen. And months go by, nothing. Again, once at the point where you see that, okay, they're not going to pay, then you could claim it as a bad debt deduction. So, and then you have the last category, which is non-business bad debts. Most of you are probably not going to really fall into that category. Those are very, very rare categories, or like you did service in exchange for stock, for example, and the stock wasn't issued, or stuff like that. Very, very rare cases. And again, you have to consider it worthless. You have to consider like, oh, like this person just did not come through, and this person will not come through. I've tried, and they're just not going to come through. It has to get to that point for you to be allowed to consider it as a bad bad debt. Okay, so I think I went by that pretty quickly. There is time. That was it. Yes, that was it. So, because at this point we can open it up for questions, um, if any, obviously. Hopefully everybody's still awake. Can't hear you. I think you're on mute. I can't hear you.
The classic, the classic Zoom, StreamYard, streaming service. Let me not unmute myself before I start running my mouth. I love these moments. So, community, any questions from the community, please feel free to ask away. Angela, if you're still with us, if you have any questions for Juan, please feel free to drop them in the box and he will answer them. I am also going to drop your information in the chat. I know that that last slide just contained it, but it may not have been up long enough for everyone to catch your information. So I'm actually going to drop it in the chat. Well, as your phone number, let me grab that. And I'm like, I had so many questions come up for me, but none that are like, you answered them so well and you were so informative that you answered so many. Athenia, I know that you dropped in the chat that you will start using your business credit card. Will you say more for the community so that way, just in case they missed what Juan may have said, it actually informs them of what you mean? If you can.
About the business credit card?
Yeah.
Um,
I'm on mute.
Stay Same thing. It was one of those days. I love it.
Hello, everyone. Yeah, so no, I was just saying because I'm notorious for using my my personal credit card, because I just usually don't walk with my business credit card often. But hearing that I get more that the interest from the credit card can be deductible makes me more inclined to make sure I walk with it. So I was like, oh, okay, that's definitely a benefit. And I don't think a lot of people know about that benefit, because, it's like, what is the difference between me using my business card and my my personal card, in addition to, other, but just knowing that that's a tax benefit definitely is helpful.
And it's a popular one. It's a popular one. Many people, especially when you start, because it takes time to build business credit. I mean, that's another thing. It's not like you can just walk into a bank and say, hey, let me get a credit card. It's not as easy as what an individual side. So I understand that it happens a lot to many business owners, and it's my card and I'm spending it. So it's easy to think that, yeah, you can treat it as a business, but unfortunately, no. If it's not under the company name, then it's not.
Mhm. Yeah, and like you said, businesses also, I mean, like my credit line for personal is a lot higher, and I think that's also why I do that. My business credit line is a lot lower, so I have to like pay it off a lot faster versus like being able to reconcile at the end of the month. So it makes it a little, annoying when it's like one charge is gonna take up the whole credit on the card.
Gotcha. Gotcha.
That's excellent to consider because here I was thinking that the main reason for doing that is when it comes time to actually filing your taxes. I was thinking that it really only mattered dividing them because when it's time to declare what was for business and what was for personal, it's easier to keep track of.
That's
But
part.
now to know that also that interest is being able to be written off versus your personal not being able to be written off, that's offered some like mind-blowing clarity for me as well. Thank you.
Yeah.
Anything else jump at you, Athenia? Because so me being a small business person, I think that's where I am with the loss for questions because it's like a real unknown for me. I've been in business for about 9 years, but as a very, very minuscule small business person, like selling to my friends and my family and things like that, servicing friends and family. But now going into this realm of trying to service the world, you definitely, this information is like right on time. And I hope that it really is serving a whole lot of others out there because, like you mentioned, there are a lot of businesses that were birthed during COVID, and sometimes just thinking that because it's so easy to start the process, a lot of us sometimes may miss these very important parts, and the last thing we would want to happen is years down the line for things to come back and nip us in the bud
Mhm.
because we didn't learn right here right now or while the baby was I often refer to businesses as babies,
Mhm.
while the baby is young. You want to make all your mistakes while the baby's really young
Right.
versus once they're older, and those mistakes can now actually impact them a lot higher than when they're smaller.
Right. Right. That's a very good point. And many of us business owners, when we start, sometimes we think we're like so small that it's insignificant to do these things
Mhm.
because we're too small. "Oh, I'm just starting. When I get bigger, when I grow, and that's great. You get there, but then when you're growing, now your focus is on everything else, and you
Mhm.
forget that you have to go back and fix these little things to our benefit. I mean, it's to our
Yeah,
benefit.
yeah.
It only hurts us when we don't do them, right? So, but yeah, yeah, that happens a lot.
And to the community, I just want to share. So Juan is my accountant, and so and he's great because I'll message him a million questions, and I'm like, all right, the end of the year is coming, and I want to reduce my taxes. So what do I need to do? I'm like, what I need to purchase, what I need to spend. So I bought a new laptop because I was like, he was like, you need to make another major purchase, so go into that depreciation. So I'm like, okay, what else do I need to do? So really just trying to, having a tax accountant is helpful. And a lot of people are like, oh, I can't afford it. And not for nothing, I'm like, I can't afford not to have one, because it hurts me at the end of the year. I mean, because of him, I'm more knowledgeable, and people will be like, oh, well, where'd you learn that? And I'm like, hold on, let me connect you to Juan. So that's how the conversations are always going for me. Because he has made himself so accessible to be able to answer questions to us layman folk. I could still, and now I'm going into another level of my business where I'm managing multiple businesses at one time, with multiple different accounts, and like that's a whole new world to now consider and to be aware of, and how all of the nuances with those things happen. So just being able to, like you said at the beginning, it's like, oh, I'm so small, it doesn't seem significant. And I tell people all the time, it is way more significant to have someone in your corner that's an expert to be able to answer questions for you than to not, because you will lose out on money that you could have got back. Like, I think I probably would have lost out on so much at the very beginning of my business and inception if I didn't have an accountant that I was working with throughout that time. So that definitely thank you for that one, and for my late messages and early morning calls, like frantic, like what is this? I just saw something in the news about this new program or new platform, or just even being able to assist with helping me to find ways to apply for grants, or once grants start to come through, how to apply them properly in the right spaces. So, and like I said, so I'm going into being a nonprofit business owner shortly, with our Juneteenth brand. We'll be
That's going to be
turning
exciting.
into nonprofit world, and so this is different. This is a different world for me, because everything that I was doing before was all about for profit. How do we, make a for profit? And now having to change gears a little bit to what will be the nonprofit arm, and how that will continue to make money so that it can pay for itself, as well, but in a different manner as the end goal.
Of course. No, that's going to be exciting. Knowing you, I know that's gonna really explode. And that's why I know all the people that are around you. I know they're going to grow too, because it just rubs off. You're a wealth of knowledge, and the fact that you're always wanting to grow, that's I'm telling you, that's going to rub off on a lot of people. I
I
know.
was just getting ready to say, listen, Juan, we're here with that thought. We are here with that thought because I know that I've grown exponentially since I've been blessed with Athenia entering my life. So that is definitely one of her gifts, one of her many, many, many gifts. So I too am excited to not only be part of the journey, but also see where the journey is going to take her and us,
Yeah.
because I am one of those around her, and you as well.
Yeah.
Just the fact that she's introduced you to the community right now as our accountant. Heard that? Our accountant.
Nice.
Um,
I
so,
like
like,
the plural. I like
question
it.
for you, like, I don't know,
Sounds
maybe
good.
business owners, this is even something that is coming up for me right now. So, does your accountant need to be licensed in your business's home state, or can your accountant live and be licensed anywhere, or how does the process of attaining an accountant go? What should we new business owners be looking for outside of being as detailed and as accessible, which
Right.
are two
Right.
things that I've picked up on you from just this hour and some change of knowing you.
Okay. Well, on the tax side, there are three entities. Well, no, there's more. I'm sorry, no, there's more than three entities. But I'm just going to mention the three most common, because again, if I go into detail, we'll never finish. That are allowed to represent you in front of the IRS in case of ever having an audit, right? And that's CPA, enrolled agent, and a lawyer, an attorney. Those are the three of the ones that they can represent you on whatever with the IRS. The CPA part is a state, is a per state certification. Enrolled agent is a federal designation. So all 50 states, as long as obviously in the U.S. obviously only. In the United States, doesn't matter what state, where you're at, an enrolled agent can represent you in case of an audit with the IRS. So that is the difference between the two. They both have representation rights, don't get me wrong, but the CPA is a per state designation, and an enrolled agent is at the federal level. Doesn't matter what state, doesn't matter who it is, or what the situation is. So that's also that's a big thing they need to look for. Another big question to ask a potential preparer. I mean, not just me, obviously, any potential preparer. Make sure that they have a preparer identification number. Okay, that when they're preparing these returns, their name shows up. The IRS knows that it was prepared by them, because a lot of there are a lot of some preparers out there. Unfortunately, they still exist that they'll just do phantom returns, and because see the thing about the self prepare softwares like TurboTax and H&R Block, and there's others. The self prepare softwares, when you prepare them, it says that were prepared by you as the individual. So some of the phantom preparers use those softwares, right? TurboTax, H&R, we all know them. They're no secrets. And they're approved by the IRS. I mean, there's nothing wrong with the software. It's just that it comes up as that the individual prepared their own return.
Wow.
And when that happens, if we have a problem, who do you think they're going to come after? They're not going to come after what preparer. There's no name here. They're going to come after you. So that's a big thing to look at. Do they have a preparer identification number? There's also, the IRS does have a directory of preparers as well. It's actually something, I don't know why they don't promote it more, but this is something that does exist. And you can go in and you put in your zip code, and you can put in it's the first three letters of the last name of the person, and it'll come up what their designation is, what they're certified in, or whatever. So those are ways to look at, that you're dealing with somebody that really is, that the IRS deems somebody that they're knowledgeable and you can deal with, and that the preparer is on the side, on your side. Obviously, they want the best for you, but it's also trying to follow the law as well, because obviously there's both sides to the game, right?
Gotcha. So stay away. So in other words, stay away from those preparers that ask you, do you have any kids? Do you have any kids that you don't have that you can get?
Right. Or that offer you a kid to put on your taxes. You gotta run away from that. I'm telling you, that's not going to work. You got to run away from that.
Gotcha. It'll catch up to you eventually.
It will catch up, and the problem is it catches up to you when you don't have the money anymore, which is 2-3 years down the line. That's the problem with those situations. You'll get your refund right away. You'll get it, but then 2-3 years later, you get this letter. Then you go to them, and trust me, they're not going to do anything because they know what they did.
Well, thank you. We are at the hour. I don't know if you have any last words, Juan, that you want to share.
Everybody has my contact info. Anybody that wants to reach out, free consultation, you can ask Athenia. I'm available anytime. I'm not exaggerating. You can ask Athenia if you think I'm exaggerating. And yeah, any questions, want to reach out, anything, like I said, the 10 that I wrote are just 10 I selected. There's a lot more. And if you have any questions on something I didn't mention, or wanna expand on what I did mention, again, you can feel free to reach out. I have no problem answering questions.
Thank you. Thank you very much, Juan. We definitely appreciate you joining us. It's been a long time. We've been trying to get you on, and we finally did. So
it's a pleasure. It's a pleasure.
So, and we're going to continue to pull you in for some other things because you are a wealth of knowledge. Like I said, I have appreciated working with you for the last couple of years, and look forward to expanding my businesses, working with you moving forward. And thank you, Jamie. I appreciate you for jumping in and supporting on these monthly/weekly Learn and Laugh that we've been doing. This has been great. We have another one next week, Thursday as well. And we're going to be talking about maintaining your books next week. So everything has kind of been in line with each other and in sync. We talked about personal and how all of those things affects you and how you're managing your budgets and your credit scores, etc. Today we talked
And
about taxes,
legacy and
right?
taxes and
And then next week we're going into more business. So this is the space if you have a business, looking to start a business, to figure out how to grow your business. So next week we'll be talking about bookkeeping, what that looks like, why we do it, what are some of the concerns and questions you have around it. So we hope to see you next week at 12 right here on Thursday. Have a great one,
for
everyone.
your
Have a great one.
community. Thank
Thanks.
you. See you
Bye.
next time.